All right, let's get right into it. Today, we're breaking down a really powerful framework for day traders. It takes a tool you probably already know, the standard deviation, and uses it in a way that's, well, pretty uncommon. We're going to see how it can help answer one of the toughest questions in all of trading.
I mean, this is the million-dollar question, isn't it? For any trend trader, this is everything. You see the market taking off, it starts pulling back, and you're just sitting there wondering, is this a little dip I should be buying? Or is this the start of a complete reversal that's going to run me over? This framework, it aims to give you a much, much clearer answer.
So, the foundation of this whole strategy is the standard deviation tool, or STDV for short. At its heart, it's pretty simple. It's designed to measure the size and, the volatility of a price swing, and then project potential levels out into the future where the price is likely to have a reaction. Now, to use this thing effectively, you first have to identify what's called the manipulation leg. And this isn't just any old price swing. It's that last significant push against the trend, right before the market makes its real move. You can think of it like the final fake-out. And that's what we're going to use as our measuring stick. So here's how it works in its most basic form. You're on a low time frame chart, maybe a 1 minute or a 3 minute. You find that manipulation leg, then you just anchor the STDV tool from the very start of that leg to the very end. The tool automatically does the rest and projects these key levels out. But the two we really care about are the -2.5 and the -4 lines. Those are the ones you gotta watch.
And right away, you can see this tool has a really cool dual purpose. If you're looking to get into a trade, you're watching for the price to pull back and reverse at one of those projected levels. But hey, if you're already in a trade, you can just flip the logic and use those exact same levels as high probability targets to take your profits. It's a simple idea, but really effective.
Okay, but that was just the basic stuff. Now we're getting to the real core of this whole thing, the advanced framework. This is where we take that simple tool and turn it into a full-on trading model, just by adding some all-important context. And the core idea here is incredibly powerful but simple. Instead of just blindly taking any standard deviation setup you see on a 1-minute chart, you first go look at a higher time frame, like an hourly chart. You use that to figure out your overall directional bias. You're basically using the big picture to give you the green light on the small picture. So what are we looking for on that higher time frame chart? We're hunting for a key level, a major support or resistance zone. This could be something like an old low in an uptrend, or maybe a fair value gap, one of those price imbalances. These are the spots where the big money, the institutions, are likely to step in, so we expect a pretty big reaction there. Okay, let's build this out into a full checklist, a step-by-step guide. First, you establish your bias. Let's just say it's bullish. Second, you find that key higher time frame level below where the price is right now. Third, you switch down to your low time frame, and you measure that manipulation leg as it pulls back towards your big level. And here's the magic. Step 4, you are looking for perfect alignment. You need that -4 standard deviation projection from the little chart to land precisely on top of your key level from the big chart. When they line up like that, you found your high probability zone. All that's left is to wait for price to hit it and give you a clear reversal signal to get in. All right, theory is great, but let's see how this actually works in the real world. We'll start with the conceptual model, and then we're going to break down a live trade example, piece by piece.
So here's that ideal bullish setup we just walked through. The big trend is clearly up, price is pulling back down to a really significant old low. You measure that pullback on your lower time frame, and bam, the -4 standard deviation level lines up perfectly with that old low. That confluence, that perfect meeting of two ideas, creates an incredibly powerful signal to start looking for a buy entry.
Now, what's really cool is seeing how this works in reverse. We've got a recent short-selling trade example that puts all these exact pieces together. So let's deconstruct it right now. Context is absolutely everything in trading. So for this trade, the bias was bearish. The plan was to sell after price ran above a key level called the Asia high. But, and this is crucial, the setup was only valid during a very specific time window, the London Open, and it also had to line up with the structure of the hourly candle. See, it's not just about the tool, it's about the time, the level, and the structure all coming together.
And this quote from the trader who took the trade. This is so important. It shows you this is not some robot mechanical system. At one point, the price actually hit the entry zone, but he didn't take the trade. Why not? Because the hourly candle at that moment looked bullish. That kind of discretion, that ability to read the context and just filter out the setups that don't look quite right, that's a huge part of making this framework actually work.
So, after all that patient waiting, the trade is finally on. The setup is confirmed. But now comes the second half of the whole equation, right? Where in the world do you get out and take your profit? And this is really the most elegant part of the whole system. You use the exact same tool. You just find the last manipulation leg that actually created the high where you entered your short trade. You measure that leg, and the projected -4 level becomes your new profit target. And just like you did for the entry, you look for a little extra confirmation, like seeing if that target lines up with another significant old low. So let's wrap all this up and really boil it down to the most important takeaways. It's really all about using this one tool for two very precise, very different jobs.
When you're looking for entries, its power comes from that alignment, getting that small lower time frame measurement to sync up perfectly with a major higher time frame level. And for exits, its power is in projecting a totally logical target based on the specific price action that got you into the trade in the first place. It's a complete system for both getting in and getting out.
Seriously, if you remember just one thing from all of this, let it be this. The strategy isn't just about the standard deviation tool. Its real secret sauce is confluence. It's that powerful moment when the right time of day, the right higher time frame price structure, and that precise STDV projection all line up. When those three things come together, that's when you have a truly high probability setup on your hands. And that leaves us with one final thought to chew on. Having a detailed, systematic framework like this is clearly powerful, but is it the complete key to consistent trading? Or is it just one very specialized tool that has to fit into a much bigger, much more complex puzzle of psychology, risk management, and good old market intuition? Something to think about.